And what I want to talk about is annuities and how they affect mortgage advisors. That's really where I want to go with this one. So the title here is Annuities. Now, you probably remember those from your CMAT training, but annuities and mortgage advice. There you go. One of the challenges with CMAT 1 and some of your CPD as well is that you read about annuities. You think, well, they don't affect me. I'm not a wealth planner or pensions advisor, so I'm not going to get involved with you. But they do affect mortgage advice, and I want to share with you how these CMAT 1E type topics do affect the advice that you give as a mortgage advisor. So, what is an annuity, and why are they all the vogue at the moment? Well, an annuity is a return on money which is based around gilt yields. Now, gilts, of course, as we know, fixed interests have been going on upwards recently since the mini budget. In fact, before then as well. Gilt yields, as they call them, are on their way up, and that's good news if you're an annuity holder or you want to purchase an annuity, because they're getting much more popular now. Now, Hargreaves Lansdown have quoted that the annuity rate is the highest since 2009. So, that's a long time now since annuities have been higher. So, it's good news. So, what is an annuity? Well, an annuity is you having a lump sum of money. You've got a big chunk of money and you give that money to the insurance company. And the insurance company looks you up and down and says, right, okay, we'll have that big lump sum, thank you. And we're going to pay you £2,000 every year until you die. That's pretty much what the annuity is. So the insurance company, of course, takes this lump sum and they'll put it on in their investments, they'll put it in their gilt funds, and they'll pay you an income based around gilt returns. That's really where it comes from. So, of course, annuity income is much higher now because gilts are higher, and that's the key thing. So how then do annuities work? Let's talk about some of the detail with annuities. Now, there's two types of annuity for you. So let's get a little graph going over here. The first type of annuity is known as pension annuities. There you go. The pension annuity. Let's squeeze that in for you. Used to be called compulsory annuities because you had to buy them with a pension fund. Now, these are annuities that you purchase when you have a fund from a pension pot. So I've got a small pension pot which I've accumulated over the years from various pensions. I've got this pot of money. I can't just go and spend it, but you can withdraw it all now, but it's taxable under UF Plus and FADs and things. But the point is, though, that this fund can be used to buy a pension annuity. The other type of annuity, which affects mortgage advisors a little bit more, are purchased annuities. So let's squeeze this one over here. Now, a purchased annuity, squeeze that in there. A purchased annuity is very different because this is something which you use to buy your annuity with your own money. You've got your own cash, your own fund from somewhere. You've saved money or whatever. So purchased annuity. So let's take a look at the different types. So I'm going to draw a little graph now for you, and we're going to get colour. So let's take a look at pension annuities first of all. So I've got here a little graph. So let's put the graph here so we can see how this is going to work. There you go. Now I've got two parts to my graph. The vertical, as you can see there, is the amount of money you're going to get, so high or low. And this one is the amount of time. So that's the graph there that I've got. For those of you on podcasts, you can't see this, but let's describe it to you as we go along. Now I've got four types of annuity under the pension annuity banner for you. The first type of annuity is a very straightforward one. It's called the level annuity. And what happens with the level annuity is that it pays you an amount of money which remains level until you die. So let's put a little coffin there for you, a little tombstone to indicate. And that's the whole point about annuities. It pays you an amount of money, this is known as level, until you die. So the amount of money it pays you is fixed. It doesn't go up, doesn't go down. It's paid every year until you die. And if you're looking at providing an income on retirement, that's a pretty good thing to have, isn't it? But of course, inflation now is hitting us all. CPI is nudging the 10% mark. We're back to high inflation as an economic ill. So people's income will be eroded by inflation. So what most people tend to do is they have what's called an indexed annuity or an increasing annuity, call it what you like. Index means it's linked to some kind of index. What happens here is you get less to start with, but every year it typically increases with some kind of index, maybe CPI, it might increase by 5% or whatever it is. And that's known as an indexed annuity, which is easy to understand, isn't it? Really, if you think about it, it makes sense. You're going to start off with less, but as time goes on, it'll get bigger and bigger because inflation will keep it rising. But it handles the cost of living problem, doesn't it? There's another one called joint life. Let's squeeze this one in for you. Now, joint life annuity pays an income to a couple effectively. So let's squeeze that in there in green. Now, the whole point behind the joint life one there is that when you die, there's an indication of dying, the annuity or a reduced amount normally will then be payable to your spouse until they die. There you go. That's known as a joint annuity, which is what you want if there's a couple, if there's two of you. The last one is known as an enhanced annuity. Now, an enhanced annuity is payable to somebody whose life expectancy isn't as good as the average. Now, insurance companies, of course, are very good at assessing people's lifespans. That's why they're good at giving you annuities. They've got loads of data for that. But if you've got some kind of illness, some kind of condition, which means that you're not going to live as long as everybody else, you'll get what's called an enhanced annuity. Now, an enhanced annuity starts off at a much higher amount, as you can appreciate, because they're not going to have to pay it to you for very long, because you are going to die earlier than everybody else. That's the whole point behind it. Hence, the enhanced pays a little bit more. So they're the 4 different types of pension annuity. Come on to purchase annuities in a second. Now, the whole point behind the pension, this is the mortgage link for you, is that somebody has a fund, they have a pot. Let's draw the pot up for you. Now, people have a pensions pot. There you go. That's the end of the pot, isn't it? Now, that's money which they've built up. Now, that pensions pot can be taken in its entirety, but is taxable. You can, though, take a quarter of that pot as tax-free cash. Pension commencement lump sum, they call it. That 25% is tax-free. Now, that is what mortgage advisors use to pay interest-only mortgages. Not so much these days, because it's never really been popular, and most mortgage advisors can't give advice on pensions, so they tend to steer clear of it. But you could do an interest-only mortgage supported by the 25% tax-free cash of your pension. That's obviously a good thing. The rest of the fund or the pot is then used to buy the annuities we've just spoken about. So that's the old-fashioned way of doing it. That'll become more vogue now as people see annuity rates going up because, as I say, they have increased dramatically with the gilt changes. And that's important to know that. Let's take a look at purchased annuities next then. And we'll have the same graph because it'll be the right thing to do. So let's put the graph in here so you can see this working. There you go. Vertical is the amount of money and the horizontal is the time. Now remember, a purchased annuity is an annuity which you buy with your own money. And that's a very different one as well. The beautiful thing about this one is that some of the income is tax-free, which is quite a benefit really, isn't it? If you think about it, if you had, say, £100,000 of your own money, which you gave to the insurance company to provide you with an annuity for the rest of your life, then they will pay you that income until you die. Now, you've given them £100,000. Now, some of that £100,000 is going to be given back to you each month or each year, whatever is the period in which you're receiving the income. And that return of capital is actually tax-free. The interest bit is taxable. So of your income from the annuity, a fair chunk of that is going to be just your money coming back to you each month. The rest of it is interest, which is based upon the gilt yield. Now, the interest is taxable. The capital return is tax-free. The pension annuity, by the way, is all taxable. And that's something to bear in mind. You get 4 types, which you might not have come across actually, so I want to describe these to you. The first one is known as a temporary annuity. Let's put that in green. Now, the temporary annuity is paid to you for a temporary period of time. There you go, temporary. and it might only be for, say, 10 years, and it stops. You don't die, it just stops. These used to be used for school fee planning. You bought an annuity for 10 years, and it paid money every month to pay for the school fees, or it paid every term. So you obviously get a bit more money that way as well. That's known as a temporary annuity. Again, mortgage advisors wouldn't come into touch with those sort of things very much at all. You have what's called a capital protected annuity. Now, capital protected annuity would pay annuity amount. Let's put capital protected there for you. Capital protected. It's payable until you die, obviously. But if you die early, what happens is it pays. Say, for example, you died at this point. Let's put a little tombstone in there to indicate your death. If you die early, it actually will return back the capital that's not been paid to you. You see where I'm coming from? So if you died, say, in the first 4 or 5 years, that means that you have the capital that the insurance company still got gets returned back to your funds. So in other words, your capital is protected that you originally gave them. It's good if you want to, if you think you'll die early, which nobody really knows, do they? That's known as capital protected. You can have a guaranteed annuity as well, similar. This means that the income is payable for a guaranteed length of time, whether you die or not. So it might be guaranteed for 5 or 10 years. So even if you died early, the income will still be paid for that 10-year term, and it will be paid to your estate. So that's known as a guaranteed annuity. Capital protected is another one as well. 2 types that affect mortgage advisors that are interesting. I'll put this one here. We've got one here called the long-term care annuity. I'm going to put it up here for you in red. The long-term care annuity. There you go. Sometimes called an immediate care annuity, long-term care. Now, the whole point behind this one is it's payable to the care home in which you are going into. Let's just draw a picture of a great big care home. Lots of windows and doors there. So what happens? This income that you buy with your annuity, with your lump sum, it goes straight to the care home. Now, because it goes straight to the care home, it has particularly good tax advantages. No tax to pay on it, you see. Whereas normal annuities, there's an element of income tax to pay. There's no tax because it goes straight to the care home. These are jolly good when you're saving in some kind of savings plan towards your long-term care, or you have a lump sum which you buy an immediate care annuity with that money, and it goes to care home. So if you're in that marketplace, later life lending, later life marketplace, long-term care, that affects you quite a lot. The other one is the home income plan. Let's put that in there for you. Now, if you remember the home income plan is a mortgage product or a later life mortgage product, home income plan, And what happens with the home income plan is that the legacy mortgage products that back in the 80s, 90s, you would borrow money and have to pay interest. But the interest is payable by you using that money to buy an annuity. And that annuity pays you an income, which you pay the interest on the mortgage, and it leaves you a little bit left over. That was the original intention of the legacy mortgage called the home income plan. And it's in the equity release syllabus if you're interested. Not around anymore, but that's what used to happen with that particular annuity. So there's a few more annuities for you under the purchase banner, which is quite interesting as well, isn't it? And that's annuities, really. Quite a lot to think about, a bit of technicals going in there. As mortgage advisors are concerned, it does affect you. If you're looking at an interest-only mortgage protected by a pension fund or pension tax-free lump sum, that's a good one to have as well. You might get involved in the long-term care market, or you might get involved in the equity release market, and therefore you'll understand about home income plans as well. But the key thing is, though, you need to be a practicing IFA, a level 4 qualified IFA, to give advice on annuities, if of course you ever want to. So that's an area you might want to consider at some point in the future. It's moving your technical capability towards that level. So there's an update for you on annuities. Hope that's been useful.